Welcome back to this deep dive into LVMH. So now it's time for the actual fundamental analysis, and we'll start with a P equals F times V run through what you have become familiar with in terms of just estimating fundamentals, for example, sales, earnings, assets, and the corresponding valuation multiples, and then combining these into a likely future share price. And then we'll see how we can use this for estimating annual total returns, which include share price appreciation and annual dividends. And this final total return number can be seen as a combination of how much are fundamentals changing, how much are valuation multiples changing, and how much additional return are we getting from dividends. So it's F plus V plus D equals the total return. And it is that number that we will use together with the risk assessment in order to finally rank our stock idea versus other ideas to find out which one is our best idea. But let's move over to Koyfin, which is my preferred source for the quick run through, and we can see here how the yearly growth rate for sales has been about 12% per year. Just a quick graph-based, chart-based estimate of the likely normalized growth rate for LVMH. We can also add into this a more intuitive estimate, like is LVMH likely or not to grow faster than the economy? Well, we know that this is a company for the rich or the richer, and those classes are growing much more quickly than the rest of the economy, and those are who they are catering to. And they also have this like strong brand where it's easy for them to compensate whatever costs they have with increasing prices. Actually, it's sometimes even easier to sell their merchandise at higher prices than lower prices. So they have this strong hold on the luxury segment, which should enable them to keep growing faster than the average economy. They should at least be able to grow with the growth rate for the amount of currency and money in the system, and that has the trajectory of somewhere between 10 and 15% annually. Another way to look at it is using a key indicator like the price of gold, which also tells us something about how much money there is in the system. And gold, of course, is also a luxury good in a way. So those are intuitive triangulations of where we can estimate the total growth. And of course, we also have to combine this with our estimate of where the valuation multiple will end up. And here we have a price earnings backward looking last 12 months, and it's currently at 21.1. I don't think this has actually accounted for today's share price fall, but as you can see, 21 is the lowest it has been in like 10 years. So the market is currently afraid of something. They think that LVMH is not going to be growing as quickly as before. Actually, I would say that this is not really what the market is doing here. It just flows out of a big company and fears of tariffs and the new global order, the deglobalization and less trading due to tariffs. But I would say that since the value of a company is based on the very long-term estimates of earnings generations and the likely future valuation multiples, a few years of tariff wars, if we even get that much turbulence, is really a blip in the end in the history of things. but the market tends to overreact, and that's why we get these good opportunities to buy. However, I would again stress that we both have a technical headwind and a short term, for quarters and perhaps even a couple of years, a fundamental headwind as LVMH is adapting to the new deglobalized regime, even if that will be relaxed later on. Presently, this is a concern, and it's likely to keep to lead to continued outflows out of the general market and out of LVMH and out of huge big stocks in general. But let's move back to well, yeah, we can also take a look at the growth rate for earnings. So we have a diluted earnings per share growth rates, and it's a little bit more difficult to see what the typical growth rate has been. But apart from this crazy year 2022, it seems that they actually have an average or a median level of 15% earnings per share growth rate, and that would be tremendously good value if they could keep growing, let's say, sales by 12%, earnings by 15% for at least, let's say, 5 years. That should reward them with definitely higher than average multiple for the market in history, which as always is about 15 times forward-looking earnings and maybe 16 and a half times backward-looking earnings. One difficult thing here for us is to have an intuitive grasp of what type of growth rates leads to what type of warranted multiples. And I have created a run-through of how these things work together. So for example, if you have the base case of 8% growth, 9% EBIT, 7% net margin, then the warranted price earnings ratio is 15.3, and that's simply because I've done a DCF, a detailed DCF analysis, just summarizing the present value of all future earnings given these assumptions. And as you can see here, if I change these assumptions, for example, to 9% growth rate, but everything else equal, then we get a 17.9 warranted price earnings ratio. So this is simply the actual mathematical sum of future cash flows given these assumptions for growth and keeping the profit margin level stable. 10% growth is a 21 PE warranted, and 12% growth takes us all the way up to 35 times earnings warranted level. So you can see here we have then the table of the warranted price earnings ratio for various types of growth, and as you can see here, at a 12% growth rate for eternity, actually 35 times 25 EPS is the same thing. It's the same thing. It's the same valuation really as 15 times at 8% growth rate. So it warrants more than twice the average market multiple if we have this type of growth. And remember, we had an even higher growth rate for LVMH estimated. But I've summarized how to correspond a certain type of growth rate, a profitability, and in terms of the warranted price sales and price earnings. But I will also get into how you can do this yourself.